Chinese physical retail gold stores just completely ran out of investment bars. They are now restricting sales strictly to decorative craft gold, pricing it at the equivalent of $6,329 per ounce. Look at the screen. Western spot is sitting at $5,346. That is roughly a $1,000 premium for immediate physical possession. This is not a localized supply chain delay. This is not a temporary technical divergence. This is absolute physical scarcity, manifesting in real time inside the world's largest gold-consuming nation. Before traditional Western markets even opened, physical-backed proxy markets flashed the warning. Over the weekend, while the COMEX slept, Kinesis silver traded near $100. Hyperliquid hit $96. Paxed gold breached $. Those weekend premiums were the preview. They were the exact coordinates of physical demand. When the institutional market finally opened, the mainstream consensus looks at silver's brutal rejection this morning and calls it a textbook growth scare. They point to the 50 to 60% industrial demand profiles, solar photovoltaics, electric vehicle chassis, advanced electronics, AI data center infrastructure, and defense manufacturing. They argue that a sudden, catastrophic energy supply shock instantly kills forward industrial consumption projections. They claim the factories will power down, the demand will evaporate, and therefore, the industrial metal must reprice lower to reflect economic contraction. That is the illusion, not a natural market reaction, but a forced liquidation event operating under the guise of macro logic. Silver was violently shoved below $90 before the New York trading session even officially opened its doors. A nearly 8% total collapse executed in under 2 hours is never organic price discovery. It is not a fundamental reassessment by long-term value investors, carefully adjusting their discounted cash flow models. That is macro cover for a localized, algorithmically driven liquidity rate. The mainstream consensus looks at silver's brutal rejection this morning and calls it a textbook growth scare. They point to the 50 to 60% industrial demand profile, solar photovoltaics, electric vehicle chassis, advanced electronics, AI data center infrastructure, and defense manufacturing. They argue that a sudden, catastrophic energy supply shock instantly kills forward industrial consumption projections. They claim the factories will power down, the demand will evaporate, and therefore the industrial metal must reprice lower to reflect economic contraction. That is the illusion. Not a natural market reaction, but a forced liquidation event operating under the guise of macro logic. Silver was violently shoved below $90 before the New York trading session even officially opened its doors. A nearly 8% total collapse executed in under 2 hours is never organic price discovery. It is not a fundamental reassessment by long-term value investors carefully adjusting their discounted cash flow models. That is macro cover for a localized, algorithmically driven liquidity rate. Listen up, because what just happened in the gold and silver markets is a masterclass in financial warfare. When the market opened, silver gapped violently from $93 to nearly $97. Gold shot straight past $5,400. But then, a massive reversal slammed them back down. To the untrained eye, it looks like a failed breakout. It's not. It's a smokescreen. While Western traders were sleeping, China initiated a full-scale physical buying frenzy. The largest e-commerce platform priced gold at the equivalent of over $5,500 an ounce before its entire digital system crashed. Total login failure. Why? Because a huge chunk of China's 336 trillion yuan in savings tried to buy physical metal all at once. Every major Chinese bank reported a buying rush. Every Chinese gold miner hit its daily limit up. This isn't just buying, it's a stampede. You're rewatching a massive premium form because the physical metal. Simply does Yuan exist to meet this demand at Western paper prices. In a true growth shock, the market follows a precise order. Gold leads, then silver, then platinum, then copper. Gold is pure money, the ultimate safe haven. The more industrial a metal is, the more it struggles with growth uncertainty. Now, let's talk about silver. Just as retail sentiment hit peak euphoria, screaming for a moonshot, we saw a targeted strike. This flush was engineered to shake out late entries and reset conviction. Let's look at the hourly silver chart. When the paper market slammed silver down at the New York Open, where did it stop? Exactly at the 150 exponential moving average. The institutional algorithms found that level and bounced the price. This isn't advice, just education. That moving average is a critical firewall. If it breaks, the trend fractures, and we could see a cascade down to levels designed to trigger margin calls. But here's the real story. The physical versus paper disconnect. While Western paper price sits near $90, Shanghai Physical is trading at a massive premium. The East is demanding physical settlement. And you can't satisfy a physical deficit with a paper algorithm. Keep your eyes on the data. Thanks for watching. They orchestrate the volatility mechanics. They systematically pump the derivative price to pull retail liquidity in at overhead resistance. And they aggressively dump the asset to trigger automated stop losses at key technical support zones. They execute this cycle ruthlessly. Verify this yourself. The ETF holdings and authorized participant reports are completely public. To understand why the tape is behaving with such erratic violence, you must quantify the macro nexus. The scale of the geopolitical fracture unfolding right now is entirely unprecedented in modern market history. Iran has not launched a localized strike. They have systematically targeted 15 sovereign nations or military installations simultaneously. Israel, the United States, the United Arab Emirates, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, alongside French, Italian, and British forward operating positions. This is not a contained regional skirmish. Multi-front kinetic assault on the world's most critical energy extraction and refining infrastructure. Look at the operational halts. Saudi Arabia's Ras Tanura refinery has formally halted operations after sustaining an Iranian drone strike. That facility is not a minor pipeline. It is the absolute largest oil refinery in the kingdom, processing 550,000 barrels of crude oil per day. That refining capacity is now entirely eradicated from the global grid. Simultaneously, Iranian drones executed a direct strike on Qatar's Ras Laffan energy complex. That complex represents one of the most critical logistical hubs for liquefied natural gas on the planet. Qatar accounts for roughly 18 to 20% of the total global liquefied natural gas supply. Qatar Energy has completely suspended LNG production. In immediate response, European natural gas prices exploded 47% higher in a single trading session. That is the absolute largest one-day price expansion since the Russian invasion of Ukraine in 2022. It is not a pricing glitch. It is institutional supply terror manifesting directly on the order books. In the airspace, the escalation is absolute. Kuwaiti air defense systems shot down 3 United States F-15E fighter jets. The United States Logistics Command has forcibly canceled 41% of all scheduled commercial and military support flights across the Middle East. The U.S. President explicitly stated on the record, "We haven't even started. The big one is coming soon." Calculate the net impact. 30% of the total global oil supply is effectively offline or frozen. The Strait of Hormuz is functionally paralyzed. Yet crude oil is going down. Oil initially gapped higher by 8 to 9% on the open, only to be systematically faded from $73 down to $70. 30% of planetary supply is eradicated. Yet the price is mathematically suppressed. The paper short stack is aggressively burying physical reality, executing a concentrated shorting operation to buy time while the physical pressure builds underneath. The paper markets and physical reality are fundamentally separating across all asset classes. Now the honest case for caution, because balance is what separates analysis from promotion. A near 8% dump executing in under 2 hours is a severe structural fracture. Gap fills are a mechanical reality of these markets. We gapped up aggressively, and the market immediately sought to fill that void back down to the origin point. If the 150 IMA on the hourly chart fractures and flips from support into resistance, the $84.90 target becomes a highly probable gravitational pull. Furthermore, the divergence in the mining sector is glaring. While Chinese mining operations are hitting daily limit-up circuit breakers, Western mining equities are currently refusing to track that violent upside. That divergence is a massive warning sign. It explicitly signals that Western institutional capital is hesitant, refusing to fully commit to the breakout narrative until the geopolitical dust settles. These are verifiable structural risks. Ignoring the potential for a deeper liquidity hunting flush is mathematical suicide. The convergence of these data points is absolute. China's digital e-commerce infrastructure completely collapsed under the crushing weight of 336 trillion yuan attempting to secure physical gold. Physical retail stores possess zero investment-grade bars, demanding a $1,000 premium just to release decorative alternatives. The $12 Shanghai silver premium survived a coordinated Western paper slam without yielding a single cent. 30% of the global oil supply, including Qatar's critical LNG infrastructure and Saudi Arabia's premier Ras Tanura refinery, is immobilized. A multi-front kinetic conflict now actively spans 15 sovereign nations. Yet, The paper derivative market suppresses oil at $70 and punishes silver at $90, entirely divorcing derivative pricing from physical existence. This is financial warfare education, not advice. Protect your capital. Invest with logic, not hype.